Good afternoon, traders. This is Tony D from easyMarkets in Sydney. An update for you today. We have a little bit of interesting breaking news here. The Chinese stock market has just gone into a bear market, fallen down from 15,000 down underneath 12,000, so underneath that 20% magical number. And look, things are pretty negative over there sentiment-wise. Obviously, the economy has been slowing down, but the government has already done a lot of measures to try and stimulate things. So it's pretty hard to see exactly what they can do here. Say from buying stocks outright, what they can do to help sentiment when the market's trying to find a fair valuation. It can be pretty brutal in terms of the length of the downtrend. But this has been going on now for nearly 6 months, and so far the rallies have been sold. So something to keep an eye on. If it becomes a bit more combined with some of the Chinese data that's come out, it becomes a bit more of a theme out there that the Chinese economy is slowing sharply, or sentiment is weak, then that's going to have a lingering effect on the Aussie dollar, which while most of the market was able to rally against the US dollar last night, the Aussie dollar was not. So let's have a look at the Aussie dollar. Still remaining underneath 74, whilst dollar yen dropped back below 110. The euro itself climbed back above 116, and pound surged on the Bank of England, having a little bit more of a hawkish tilt than you would expect. The chief economist of the Bank of England actually voted for a rate hike last night, which is voted against no rate hike. So that's basically voting for the rate hike. But there's 3 voters last night from the Bank of England, and that was a surprise. The market thought there was going to be 2, but the chief economist also hopped onto the bandwagon there of dissent, and so the market's like, whoa, okay, maybe we have ourselves a new situation where they're going to be raising in August, and that's going to be able to help underpin the pound going forward for the next few months. As long as data holds up, then you will see the market still remain optimistic, if not pricing in a rate hike in August, and that's the sort of thing which can really help a currency rally. Now, the euro rallied mainly on the weakness of the Philly Fed manufacturing, which dropped to 2-year lows, and that was a bit of a surprise. Sentiment's been pretty strong in manufacturing in the US, and that sharp drop there has a bit of a noggin scratcher, enough to cause a pause in the US dollar rally. And you can see that from the dollar index here, which was starting to break out above 95, and that 95 level was being closely watched, and back underneath it, that's a bit bearish here. If the US dollar was to have a couple more days of selling, traders will start to talk about short-term tops being put in the US dollar, and perhaps range trading would be able to be established here on the euro and the pound at the very least. But let's see how we go. The stock market's been easing throughout most of the week as well. It's starting to get a little bit more serious. Not aggressive, sharp daily falls, but enough to gain the interest now, especially as yesterday's little rally did not hold. Now we're starting to get back towards the previous lows, and the breakdown here will get the bears a little bit more aggressive and start to threaten the general recovery that you've been seeing in US stocks since the sharp sell-offs early in February. So it is interesting that the market is starting to get more bearish slowly over time, rather than just the snap bearish that you would have seen after headlines about Chinese trade wars and such early in the week. It had looked like they was able to shrug that off, and definitely if you're looking at certain sectors or certain parts of the US economy, like the US tech stocks, they still aim very much in an uptrend, and it's if you're looking at this, you wouldn't be able to see there was a problem at all. It's only with the Dow now that you're starting to see the market get back to those levels. And if you're looking at something like the DAX, which is a little bit more evenly poised, it's a little bit more mixed as well, given the last 2 days of selling. So it is, the door is open here for there to be some new risk off if the market was to break down today. It's definitely by no means a done deal though, as it's been quite resilient or past. But that would have impacts for the dollar yen, and potentially if the euro wants to rally, this in this sort of environment as well, then you will have that opportunity from the stock market story itself falling. Alright guys, perhaps in the very short term the crosses might be a little bit of the way to go. You're looking at things like the Aussie Kiwi are in play, Euro Pound's in play. There's a bit of divergence now between the pound and the ECB and the BOE. And so, the argument can be made that the range trading that we've seen is finally going to break out to the downside here. Still has to, the burden of proof is definitely on the breakout rather than for the range holding, but it's a story which makes sense. So we'll see how it develops in the next couple of days. Ranges eventually break one way or the other, and for a time there, with the Brexit issues, I thought it was going to break topside. Now that they've been a little bit more reduced, and the Bank of England's closer to raising rates, and the ECB's delayed raising rates, and we're going to probably test the downside here, see if we can't potentially break out there. If it does happen, it'll cause a major rupture between the euro and the pound in terms of the relationship between the two. Okay, so the relationship at the moment is very, very solid, very, very close. The correlation, if the euro rallies 100 pips, the pound rallies 80 pips. That is the sort of correlation we're getting at the moment, and that's been holding for all year. And if it was to break down and the euro was to be able to fall without the pound falling, that's how you get a trend, and that's how you can get a move out of this range, and it'll be a new situation where no longer necessary for the euro for the pound to follow every move that the euro does. But so far that hasn't happened. It's just something that might happen, so it's just what you keep an eye on if it was to break underneath 87.